lot of what I'm going to talk about is not very glamorous, but it's required as part of being able to sell your business. So we'll start with a quick polling question here. Can we go to the next polling question?
Yeah, sorry.
Yes, the polling question is, here we go. So you have a sample due diligence questionnaire in the handout, which may be kind of intimidating, that asks, can you provide a whole bunch of documentation about a whole bunch of different things related to your business so the buyer can scrutinize it all. So the quick poll here is, on a scale of 1 to 10, how much of it could you actually deliver in the next 2 business days? So if you can deliver next to nothing, and that might be the case, then that's a 1. Or if you can deliver most all of it in the next couple of days to a buyer, then that would be a 10. So I'm curious where people feel like they are on that readiness spectrum.
About 30% have answered the question. People are coming in pretty quick here. Just give it a few seconds. All right, looks like most of you have answered.
All right, so we've got quite a spectrum, although nobody thinks they're a 9 or a 10. So that's expected here. So I guess let's dive in here. Quick summary on myself. I was very lucky at a relatively young age to get a great education in what it takes to prepare to sell your business and the process of selling your business, everything that goes into that. And then after Staples acquired my business, I worked there briefly, about a year and a half or so. And prior to the sale, I was the chief financial officer and chairman of the board at Thrive, and was kind of intimately involved in all aspects of the sale. So I saw the good, bad, and the ugly, and learned a lot from it all. After transitioning out of Staples, started a company called SmartBooks, where I'm currently the CEO, where we provide fractional finance teams for small businesses, everything from basic bookkeeping up through CFO, financial planning and analysis and advisory, and everything in between. So we work with a few hundred different small business clients, and every year, some number of them are acquired, and we support them throughout the acquisition process. So as I said, a lot of what I'm going to cover now is not that glamorous, but it's required if you're going to be able to sell your business, and it can impact not only whether you can sell your business, but also how much of that sale price you can get in upfront cash, and what are some of the pitfalls that can be avoided there. So if we look at the timeline, a lot of work is required over an extended period of time to build a business that can be sold. We advance the next slide here. There we go. So Glenn, with his value builder work, is going to be working with you a few years in advance of the time you can actually close on a sale of the business to really build that business value. Matt's going to come in, he may consult with you now, but he's going to get more deeply engaged in the 12 months or so before closing to manage that process. And Mindy's going to help you understand what your number needs to be. Do you need to get another job after you sell the business? How do you manage your proceeds from the sale? And she can advise you early on to some extent, but then really add a lot of value post-closing. I'm really focused at SmartBooks in this kind of 12 to 24 month period before closing, where you're serious about putting the finishing touches on the business and bringing it to market. You've already done the best you can to maximize the value of the business, and now you just want to make sure you are ready to go through due diligence and negotiate as favorable a deal as possible with one of your buyers. So I'm all about getting your financial house and to some extent your legal house in order so you can go to market with the highest odds of success. So I'll talk a little bit now about general accounting, and the gist of this is the cleaner your books are and the cleaner the supporting documentation behind those financial statements are, the more credibility you have with the buyer, the more professionally managed it appears like your business is, and the more leverage you have with the buyer to get upfront payment. As the buyer is going to perceive there's less risk to your business because your finances are clean. And so they're going to want to see at least 3 years worth of financial statements. Most buyers are going to be much larger businesses than you. They may be public companies, they may be private companies looking to go public or be acquired themselves by a public company. And ultimately, they want to know whether your books are kept in accordance with generally accepted accounting principles, accrual accounting around revenue and expense recognition. How technically accurate, quote unquote, accurate are your financial statements, right? And so they'll dig into a lot of that, and we'll talk about audits and reviews shortly. But they'll pay a lot of attention to what your accounting policies actually are. And they'll want to see that the financial statements tell a story that aligns with the business story you've been telling. So if you've been telling a story around how your business is scaling and you're achieving economies of scale and your margins are expanding as you grow, then they're going to want to look at the financial statements and see that, yes, revenue has been growing and the corresponding profit margins have also been growing. So what's key is having some credibility there that your financial statements match up to the story that you've been telling. As Glenn mentioned, the buyer is really buying the future profit stream of the business and all the opportunities to grow that future profit stream that they have at their disposal once they own the business and can combine it with whatever else they operate. But part of that is this concept of add backs. So we've talked about some jargony things so far in this workshop, and add backs is another one of those jargony terms. So let's say you've got you're paying 3 car leases, and the business paid $100,000 for a home office renovation for your home office last year, and you've got your kids' college bills being paid by the business through some kind of an educational assistance plan, hypothetically. So those are all real costs that you are incurring now, but they're all going to go away under new ownership, right? And so they can be positioned as add backs. So these would be expenses that are discretionary in nature, largely driven by business owner preferences, trying to take advantage of tax deductions, but they can be added back, so to speak, to the expenses that you've been reporting. So you can present effectively a larger profit margin than on paper or in your tax returns. And so the buyer can be very interested in understanding what you perceive those add backs to be, and they can be a point of negotiation. But at the end of the day, if you're running discretionary expenses through the business, they can disappear under new ownership. Make sure the prospective owners understand what those expenses all add up to and that those get factored into the sale price. I spoke a little bit about audits and reviews. So the concept here is you can prepare internally prepared financial statements and deliver them to the buyer and certify that they're accurate and identify all the deviations from GAAP and all that good stuff. But nothing really beats an external validation by a CPA firm in a full audit of the financial statements. This isn't necessarily required, especially if you're a smaller business. It's often not required. It's very stringent. If you have not been paying much attention to accounting policies and procedures, the audit can be very difficult to pass. It's also somewhat expensive in addition to all the time that would need to go into having the audit done. But if you can have your last 2 years financial statements audited, buyers really like that because it removes risk from their equation. They don't have to just trust you that you're presenting them accurately. They can rely upon an external CPA who's gone through the full audit procedure and has also validated the accuracy of those financial statements. There's a step down from audit, which is called review. And so that's kind of a miniature audit. The standards are less stringent, but it's very common in the small business space to have an annual review done. And it costs, half as much of an audit and can still provide a reasonable amount of external validation to the prospective buyer. The third term you may hear is compilation. And the compilation provides, no assurance whatsoever. It's typically not even done anymore, but you may come across that term. And what it really means is if your CPA firm is even willing to do it, they'll take the financial statements you give them and put them on their own letterhead with a bunch of disclaimers, and there you go. So it's not really worth the paper it's even printed on because there is zero third-party validation that goes into a compilation. So typically small businesses are looking at reviews and then sometimes audits if they get to be more of a mid-market size business rather than a small business. So we've talked about kind of accounting, and ultimately that also involves tax. And the most common tax issue that comes up in the sale of a small business is the tax structure. Is it structured as an asset sale or is it structured as a stock sale? And that really means if it's an asset sale, then you continue to own the stock or the partnership interests in the LLC, but you sold all your assets to the buyer. If it's a stock sale, then you no longer even own the stock or the LLC membership interest. You sold the ownership to the buyer, and then because the buyer owns the entity, now they also own all the assets. And there's some different tax treatments there. The seller tends to prefer a stock sale because they can guarantee long-term capital gains tax at a slightly lower rate. The buyer tends to prefer an asset sale for two reasons. For one, they can get slightly better tax treatment with higher deductions as part of the purchase price, but most small business ends up being sold for an asset sale for a legal reason more than a tax reason. If the buyer acquires the assets and then some kind of a lawsuit comes out of the woodwork 9 months later, it doesn't attach to the assets. It stays with the legal entity ownership. So if you've sold your assets, but you continue to own the stock, and that lawsuit comes out of the woodwork, the buyer is relatively insulated from it. And the lawsuit is against the company whose stock that you still own, not the buyer. So the buyer likes asset sales to shield themselves from legal liability and get some modest tax benefit as well. Installment sales can be tricky. So if you're not able to achieve most of the purchase price in an upfront cash payment, then the IRS at the federal level will typically allow you to defer paying tax on future installments that you've yet to receive, but it's all over the gamut when it comes to states. And some states allow you to defer taxable income and some do not. So that's definitely a question for your CPA if you find yourself staring at an installment sale. The other unhappy surprise that can come up with an S Corp is although S Corps, like partnerships and LLCs, taxless partnerships, they tend to have pass-through taxation, which means there's little to no tax payable at the entity level. All the tax liability passes through to the owners. But if you go sell the assets of an S Corp, or an S Corp gets to a certain size, then states start to impose revenue-based or profit-based taxes on the S Corp. So that could be a surprise that could cost a few $100,000 at closing that you might not have really been anticipating as a deal cost. So something else to factor in. And then the final thing comes down to, small, relatively minor, but very important paperwork that can, maybe you incorporated the business 10 years ago with some CPA or attorney that you haven't talked with in 8 years. And you didn't really keep all these records back at the time. You were just trying to start the business and get it off the ground and get some customers. But there's employer tax ID notices from the IRS. There's S Corp elections. There might be, cash basis versus accrual basis elections, little nitpicky pieces of paperwork that become very important to the buyer so they know exactly what they're buying from a tax perspective. I know, Glenn, you dealt with some of these issues, right?
I sure did, especially the asset stock sale and the stinger tax. And when I found out about the nuances of these things, my deal was had progressed so far that I was uncomfortable renegotiating anything. And if I had learned about them up front, I would have had some runway to really talk about it with the buyer. And then the S Corp election, it's one of the first pieces of paper you fill out when you just started a business. So 6, 7, 8, 9, 10 years later, where is this? And I remember my wife and I digging through our file cabinets trying to find this little piece of paper. But the point with some of the stuff that Calvin was just talking about is it takes time, right? CPAs take time to do these reviews. And if it's tax season longer, and if you can't find your S Corp election and you ask the Secretary of State for it, they're probably not going to get it to you tomorrow. So.
Yeah, all these things take time. That's why I mentioned, trying to tackle a lot of these issues in months 12 through 24, so that when you actually go to market and start having discussions with prospective buyers, all this stuff is in order. And if they ask for something, you can turn around and deliver it because you've got it in order. One of the other things that ends up on the plate of the CFO is typically legal items. CFOs get stuck with that as well most of the time. And so there are typically a few pitfalls that can impact a M&A transaction. One of the biggest ones is employee equity commitments that were made, particularly in the early years of the business, but were not really consummated with written contracts, right? So maybe in an offer letter, you committed to give some key early hire 4% of the business, right? But you never really got around to actually issuing the stock or the stock option or what have you. But there's this commitment out there on 4% of the business, and then maybe you raised some more capital later, and who knows what 4% even means anymore, right? So cleaning up and kind of, you know, getting written contracts in place for all employee equity commitments is really important, and to do early rather than right before the sale, because once the deal becomes more imminent, people get wind of that, and you lose all your leverage to get these things cleaned up, because the employee, or you've got a business partner, a minority business partner who has a lot of rights in your shareholder agreement or your LLC operating agreement, you know, once they get wind that you're trying to sell the business, um, they can hold out for better terms than they would otherwise have, because they could literally be in a position to block a sale of the business, especially if it's, you know, a minority partner of yours. Um, there are typically restrictions in partnership agreements and operating agreements for LLCs against selling the assets of the equity of the business without the approval of other key owners, right? And so getting clarity around what the legal rights are between you and your business partners is critical, as well as resolving any, you know, unconsummated employee equity commitments as well. Um, and then the last bullet here is cap table, another piece of jargon that really means a list of who the owners of the business are. And it could be very basic. If you're the only owner, that's a very short cap table. You own 100% of the stock or the LLC interest in the business. Or it could be relatively complicated if you've got stock options outstanding at different strike prices, and maybe you've got some convertible debt. So it can become somewhat complicated. But when you hear cap table, it really means a list of who owns any part of the business and what are the terms of their ownership, right? So before I wrap up here, I'll just kind of reiterate the number one pitfall that I tend to see with small businesses when it comes to try to sell the business. You know, all this stuff I've been talking about, it's no fun. It costs money. It doesn't bring in more revenue. It doesn't produce more profit, but it needs to get done. But it's very tempting just kind of to put it off until there's a real offer on the table, right? And so the number one pitfall I see is waiting to get the house in order until you have that bona fide interested buyer, right? You get that phone call one day, and you're really excited. You've got this interested buyer, but then you start to think, whoa, this buyer's asking me for documents, and you pull out your sample due diligence questionnaire, like, whoa, they're going to be asking me for all these things, and I'm nowhere near able to deliver them. And then you start to lose some credibility with the buyer, because the buyer starts to question how you're running the business. And is it that hub and spoke where they're really buying an owner with some helpers, or they have an actual operating business that can operate on its own, right? And so waiting to get your house in order until you get that offer is the number one pitfall I see, because at that point, you can still probably get to a sale, but it's certainly not going to be at the price you want or on the terms that ideally you would have if you had been a little more proactive in preparing for a sale. A couple of the smaller pitfalls, there may be, you know, some business owners put together models that, you know, try to show a buyer how they have about a 40% EBITDA margin in the business, even though they've been reporting a 5% EBITDA margin, right? So you can lose some credibility if your ad backs or other assumptions are just too extremely different than what you're actually reporting. You know, good to stretch the numbers the most you can justify, but at a certain point, they need to be credible assumptions and credible ad backs that you're presenting. And then Matt will talk a lot about this too. I think what really drives valuation in the marketplace, but just having kind of an unrealistic expectation of valuation is also a big pitfall, and kind of getting that sticker shock in a negative direction. If you're thinking your business is worth 1 times revenue, but you get an offer for 3.5 times EBITDA, which works out to be like 0.5 times revenue, that can feel like a slap in the face, because you've got a very different expectation of what you think the business is worth compared to what the market's really willing to pay for it. So that can be a challenge as well. So I'm going to wrap up my piece here and open it up to any questions. If you want to reach me, here's my email and phone number. You can use that link to schedule a free consultation. Everything we discuss could be held in confidence. If you're not, at liberty to discuss it on the call right now, that's fine. Feel free to follow up with me privately later.
Thanks, Cal. So we'll keep it open here for a minute for people to put questions in. You have questions for Cal, you can hit that Q&A button. We did have one late question come in the last session. The question was, how do you look at building a brand and how does it apply to determining the multiple? Which is a very good question. It can kind of fall into a couple of different avenues there. I look at it around the monopoly control driver and being differentiated, especially if your brand, it really drives the product, because no one else can really have that brand. So to the extent you're able to build that brand, and that brand is really what, is what people are buying, think of like Kleenex and tissues, right? When people use your brand as the name for the object, but it's really not the name for the object or the product or the service, that's a huge market differentiator. We have a question. Can we get a copy of this presentation deck? Sure, Ken. We're going to have actually a link for the whole video from the entire session will be available as well. Anybody have any more questions for Calvin? All right, Calvin, is a cash balance plan an example of an add back?
So I assume that refers to an employee benefit plan. And so the question related to, is it an add back or not? Is it an above market? Okay, yeah, so it is our employee benefit retirement based plan. So the question is, are the employer contributions kind of above market to that plan? So if it's designed in a way to specifically benefit the business owner through, large employer contributions that go to the business owner and relatively smaller contributions that go to the staff, then it may fall into that add back category. There's a certain element of 401k match that is generally, common these days, but if you've got a plan that effectively has a much higher employer contribution, or most of those contributions are going to the owners rather than the employees, then that probably would fall into the add back category. Yes, that does seem very well engineered for the business owner looking at the comment here. So yes, that does definitely seem like an add back to me.
So just quickly on add backs too, this is something that I didn't know when I started down the road. I always thought that add backs were bad, right? It's, you're leasing a car through the business, you're paying for the gas, you're doing this or doing that. And I always thought that was like, the entrepreneur's dirty little secret. Turns out that's great news when you go to sell your business, because you can tell the buyer they're going to make X amount of dollars more net profit at the end of the year when they're not paying for your car or other things. And I remember the PE group said, "You don't own a boat or anything, do you?" And I was like, "No." And then they sort of joked because they had recently gone through that where somebody had used the business to buy a boat. So add backs are a good thing. Who would have known?
And I'll also add to that. I worked on a deal once where add backs were a large piece of bridging the gap between what the original EBITDA numbers and the eventual EBITDA numbers that they used to value the business. And usually, they're trying to get the deal done as well, the buyer. So they'll try to find ways to get add backs and EBITDA up to justify, especially if it's a private equity deal. Someone's looking at, sort of big brother's looking down at the deal saying, all right, well, I don't know if we're going to pay 16 times for this, but if you can find more add backs, it helps us justify the price. So it's funny, you'll think that they're on the other side of the table from you, but then you're actually working in concert to try to find these things. So it's interesting.